Let us start with the first session of the funding demystified event, that is the fundamentals of fundraising. It is always said that first master fundamentals, and it is true for everything when it comes to learning and building a startup. To help the founders in mastering the fundamentals, let us invite Mr. Gireendra Kasmalkar. A very quick introduction about Mr. Gireendra. He is the founder, director, and CEO of Ideas to Impact Innovations Private Limited, lead investor and general partner at Pentathlon Ventures, which support early-stage B2B tech startups between pre-seed and Series A, especially those building next-gen enterprises in the SaaS and tackling the problems of tomorrow with emerging technology. Pentathlon Ventures has till now invested in 10 plus startups. Mr. Gireendra is also an owner of the Ideas to Impact Hub, a leading incubator accelerator of tech startups in Pune, which is also a home to Pentathlon VC Fund. A very warm welcome to Mr. Gireendra. Without a further ado, over to you, sir.
Thank you so much, Kapil. Just making sure that you can hear me clearly and also see the screen that I'm sharing.
Yes, sir. It is visible and we can hear you clearly.
And the screen as well?
Yes, it is visible.
Okay. Let me request all the audience to put the screen in the full screen mode so that the slides can be visible more clearly. Great. So good morning, everyone. And once again, thank you, Kapil, for the kind introduction. And thanks to Arthayan, first of all, for arranging this great event on funding demystified. Such a great audience. I see that the audience already reaching about 200. So great to have you here. And looks like it's my privilege to be the opening batsman for this two-day event, talking about this in this first session on the fundamentals of fundraising. It's always a pleasure to talk to youngsters, especially entrepreneurs. And I'm very happy to see a bunch of them today for this talk. I also understand from Kapil that it is not just entrepreneurs, but also other people who are interested in this ecosystem, trying to help with mentoring, with funding, and all kinds of things that an ecosystem needs. And I hope that my talk is useful for the entrepreneurs as well as the others in the audience. And by the way, as in entrepreneurs, I also include the social entrepreneurs, because that is also one of my interest areas. And I hope the talk is useful to everyone. I've structured the presentation as more of question and answers. And incidentally, when we are planning this, the organizers told me to talk for about 60 minutes. And I'm going to try, but I thought, maybe 45, 50 minutes was more like it. And we'll leave more time for question and answers if that helps. So let's see how it goes. So with that, let me dive into the slide deck, which, as I said, I've structured as more the typically asked questions and the answers to them, which will hopefully enlighten on the topic that I'm talking about. So moving on to the next slide. Now, this is answering the question, why me? Why has Arthayan asked me to talk about this topic? And there I would just elaborate a bit on what Kapil has already said in his introduction. So the building that you see, can you see my next screen or not?
No, sir, it's still the first slide.
Okay. Yeah, got it. So this first slide, as I said, is the answer to the question why I am speaking on this topic. The building that you see on the right is the Ideas to Impacts Hub building in the Baner area of Pune. And what we have done there is there are like 25 plus startups in this building, from very small one-person startup to over 40 people startups, and even larger and more these days. There are about 350 techies working out of the building. Yeah, mainly most of them working from home as of now, but they call this building their office. And within a couple of years, this has become a leading hub, one of the topmost incubators in the Pune area. And what we have done right, I believe, is that mix of entrepreneurs that is there. It's not like everybody is young entrepreneur trying to build their startup. There are some who are really mature startups who have raised their funds, who have got prior exits. And to me, building that startup ecosystem is never like saying do step 1, step 2, step 3, and then you get success. That is not the way it works, right? You create the mix, you give the opportunity for people to mingle, and then that magic happens, or more specifically serendipity happens, as I like to say. People talk to each other, new ideas evolve. And of course we do a lot of the stuff that we are supposed to do, like there's access to mentors, corporate partners, of course global markets. Kapil mentioned about the fund has its office in the building as well. Lots of events, there are about 150 plus events that have happened in the last couple of years, and they are in fact built into channels such as go-to-market. We call it go-to-market, GTM dialogues. Then there is something on design, which is called by design. And a very interesting program that we run is called Land and Expand, where we have partnered with incubators even outside of India and give the opportunities to startups in those regions to soft land in our incubator if they have plans to be in India. So if you have plans to be in India, you soft land in our incubator and then expand. And conversely, if an Indian startup wants to get into an EU, it can get into one of our partner incubators in Europe, or for that matter, Canada, and then get into the North American or European markets by soft landing in the incubator and expanding there. So these are the kind of things that are already being done in the incubator. And of course, it is because of the fact the whole idea was conceived because our fund, Pentathlon Fund, was actually supposed to be an early stage fund, and hence in that early stage, it's always a fund plus incubator kind of a model. Just to background of the Pentathlon Venture Fund, it's a proper SEBI registered AIF Cat 1 fund. And when I exited out of my last venture, which was an IT venture, I was already mentoring startups. And the one gap that we saw at that time was, while there was a lot of energy in Pune for startups, a lot of enthusiasm, a lot of savvy, no funds. All the funds happened to be out of Delhi, Mumbai, and Bangalore. And that's where we thought, and I was lucky to get like-minded partners who thought the same, that we need to start a fund headquartered out of Pune. And long story short, it took us a few years to get this off the ground. But long story short, that is what it has turned out to be. All the partners that we have in the fund, the managing partners, are with my background, who have their prior ventures, successful ventures, which they exited out of. They grew them globally, they scaled up, and they raised funds, in one case up to Series D level funds. And then all of us exited to start this fund. So our managing partners is actually a team of entrepreneurs. We like to call ourselves a fund by entrepreneurs for that reason. And in fact, to be honest, all our investors also happen to be first generation entrepreneurs, mostly from Pune. But even from outside of Pune, some business people, some entrepreneurs are from Hubli in Karnataka. Some are from outside of India, including one corporate from the South America called Globant, and they have participated in our fund as well. Our fund focuses on early stage, as I mentioned, so especially the focus on B2B tech. And I understand that in this crowd there will be B2B and B2C, and I'll be touching upon all of these aspects. But our fund focuses on early stage B2B tech, and we hope to help our early stage startups to reach Series A kind of a level. And not only we provide funds, as per our thesis, we would actually also like to help all the startups in the areas that they might need help. And this could be then a complementary win-win situation for both the startups and the fund. So this is the background. And like I've said in my introduction video, which you have seen, because of the background of both as an entrepreneur and as a fund, I would like to talk from both the perspectives and hopefully take you through this presentation, giving you a view of how it is in the shoes of the investors when you are trying to raise funds from them. That, I believe, is a good perspective to have, and that's what I'll try to do in this presentation. Quickly moving on to the next one. Just a minute. Yeah, moving on to the next slide, and please let me know if you're seeing the next slide. I'm seeing some trouble going to the next slide. Can you see the next slide now? Yeah.
Yes, sir, it is visible.
Yeah, I have a little bit of trouble, but I'll.
No worries.
Okay. So because I'm the first session out of this event, I wanted to spend some time on what's the significance of the startup ecosystem that we are building in India, even before going to the funding aspects of it. And that's what I'm talking about in this slide. As you know, probably that India is already the third largest startup ecosystem in the world, behind US and China. And the numbers are very, very impressive. I know the statistic that I've shown is probably 1 year old, but it is no less impressive. It has even got better in this year. And the absolute numbers of startups, the growth in the startups, the dollar value or the rupee value that is associated with the startup ecosystem, all are very, very impressive numbers. But that probably you already know. That's not even the main point that I'm trying to make. The main point is this, that all this is not really a nice to have for India. All this is a must have for India. And the reason for that is that India has a very large population. And for us to grow our economy, you might have heard of this term called demographic dividend, that there are a lot of young people in our country. And these, unlike any other country, we have the largest population of the young generation. However, if our country or our economy does not grow fast enough, it will not take too much time to convert this demographic dividend into a demographic disaster if people are not finding the jobs and so on. So our economy needs to grow really fast. And what I feel startup is a synonym to, if anything, is fast growth. And why is that? That is because startup means innovation. Something new has to be done. And that new, we believe, is going to happen through the young people that I'm talking about. So on the one hand, we talk about the startup ecosystem needing to create those jobs and help the demographic dividend to be achieved and help that large population. On the other hand, we are also hoping that it's that large demography that actually helps the innovation to happen because of the young age, the startups to happen. And that, in fact, builds the large need of India to have a growing economy through these startups. So it's a two-way thing, and I think that's the significance of it. Like I said, the startup is meant to grow disruptively. Why that growth happens is because startups change something. They grow disruptively, and that's what creates a new economy and the new jobs. So that is what the importance and the significance is. The word, do you know how the word startup itself came along? I'm told, I may be wrong, it came along from the word upstart. It's a small thing that really disrupts what is happening, disrupt the status quo. And that is why we call these kind of companies startups. So it is very necessary that they grow very fast, they bring in new ideas, they innovate. And I can tell you that if the ideas are good, there is today a lot of external money available to fund this innovation and growth. And that is what we are going to talk about. So hope I've kind of told you the kind of place that you have in this startup ecosystem. All the entrepreneurs sitting out there, you are playing a very crucial role in building the startup ecosystem, which is such an important and crucial thing for the growth of India itself. And so that's why I'm excited about talking to you at this session today. Next, I want to talk about how these startups can transform India. Yes, they need to transform India, how that can happen. And let me talk about that as well. India is a very large country. And obviously, it's a large market by itself. There's no question about that. But there are some peculiarities of that large market. One, it is very diverse. As you know, we have number of states, number of cultures, number of languages spoken. And also it's geographically quite an expanse. The distances are quite large. So there is a big market, and there are some special things about this market that you have to keep in mind. One other thing that I must mention here is that over the last couple of decades, we have proven ourselves to be extremely tech savvy because of the IT industry, because of the software development that has happened out of India. We have proven ourselves to be tech savvy, and what that means is that we ourselves can build a lot of the solutions to the problems of the Indian market. And there are examples that I've given there on the slide, and the Paytms and the Policy Bazaars are very well known. They've done very well for themselves, which is not a surprise at all. So we have the market, and we have the technology savvy to build those kind of products. And not just I'm hoping for India, but then we can take them to the global market as well. And here I would like to point you out to the platform that we have built over this last decade called India Stack. I'm sure most of the people have heard of India Stack, and if some of you have not, I'm sure they've heard of Aadhaar, which is one of the big parts of this India Stack. This whole stack that I'm talking about in the screen is the Aadhaar, the unique ID, the eKYC, the e-signing, the UPI, all of which allows for cashless, presenceless, and paperless transactions, which is huge for the inclusion of the entire population in India's economy. So that is the big thing. And let me tell you, this is a world-leading technology. Not too many countries, if any, have this kind of technology, and which is a huge opportunity for startups. If these kind of platforms are there, which allow these kind of features of paperless, presenceless, and cashless transactions, this has been opened up for you in an open API policy. So all the startups have to do is build applications on top of that and take it, whatever their fintech or edtech or healthcare application they are, through the last mile to the people that actually need these kind of services. And because of India's population being large, these are going to be really large plays. And now, recently I've heard that UPI is actually being exported to other countries as well. This is not very different from what has happened in other countries. If you look at internet itself, internet was a platform, or even GPS for that matter. These were the platforms that were built by the government of the United States, by the defense departments. And then it is the private players like the Googles and the Facebooks of the world came to build their ventures on top of these tech platforms, benefiting out of these platforms and building their high-tech ventures. Exactly what we hope that the same thing will happen in India as well. So there is an opportunity of market, there is an opportunity of the tech being available, and now it's up to the startups to really leverage these platforms that are there, which are available to there, and grow their businesses on top of these platforms. What I have said so far might give the impression that startups have to be technology startups, and I'll spend a few minutes to talk about that. So the question that typically comes in, do startups have to be technology startups? The answer is not really. And while I will talk about the disruption that we have been talking about, the startups need to disrupt, startups need to change things fundamentally. And we have seen as a human society over the few centuries that most of the disruption that has happened is through technology, right from the industrial economy to the computer economy to now the internet economy. Everything has happened through technology. And so it makes sense that a lot of disruption will happen through technology. And that's why you see a lot of technology startups. One other aspect of this is that a lot of the startups are also product companies as opposed to services companies. And that again goes back to this theme that I talked about earlier about fast growth. Now, we know that if it's a product, it can grow exponentially because the product is built and you just have to find new customers for it, whereas services companies might grow more linearly. So for both of these reasons, you might find that most of the startups are tech product startups, but it doesn't really have to be so. I mean, of course, I'm giving here examples of the unicorns in Pune, like Icertis and Druva. And as we speak, only yesterday, one more has got added. Mindtickle has also become a unicorn out of Pune. And of course, there are Freshworks, like brilliant examples out of other places as well. So these are the tech unicorns which you have already heard of, and these are the tech startups. But I would also point out that there are non-tech startups as well. And so the definition of startup remains, it has to be very fast-growing, scalable ventures, and it could be the First Cries of the world, which is again a unicorn from Pune, or Oyo that you have heard of. I would also like to point out Akshay Patra, which is actually a social impact enterprise. It's not even a market enterprise. They provide meals, midday meals to students, and I've been to their facility in Hubli and how much they've scaled. So that is what is important as far as startup is concerned. It doesn't have to be technology, but as I said, most of them end up being technology startups for the reasons that I mentioned. Now, with this, let me get on to the next slide, which is funding, which is coming close to the topic that we are talking about. We talked about startups, what their importance is, that they need to be tech and all. Why this craze for startup funding? Now, does everybody really need funding? Who needs funding? And I'm painting this with a broad brush, really speaking here. But to my mind, the services companies, which are kind of growing linearly, as I said, which are profitable, may not need funding as much. Product development, let's say if there are products that are deep tech and they need to build deep tech, which is going to take a year, 2 years, these kind of deep tech are there in life sciences and so on, then even for the development of products you do need funding sometimes. But most of the other software startups probably do not need funding to build the product itself. Whereas the biggest use case for funding for startups is for the scaling part of it. The product is ready. Now we have to pump in a lot of money to make sure that the startup is growing, it's scaling. That's where the funding is really needed. So I'll give you the example of my own companies. I had a company called VeriSoft in software testing. It scaled up to 1,000 people. I sold it to a German company, which was the leader in software testing, never took external funding. I could grow it on my own. And of course, you would realize that since I had not diluted, I got the best benefit when I exited out of the company because I was the 100% owner. Learning from it, the company that I'm running today, Ideas to Impacts, is again an IT services company which delivers IT services not from the metros but from the small towns. Again, no external funding. But these are my own services companies. There is a huge, brilliant example of Zoho, which is a product company and still didn't take any funding, and that grew. They themselves grew. So the simple question to ask here is, if you are able to grow it yourself, and if you're able to achieve the scale that you want, why would you give away, dilute your equity by taking funding in? So yes, funding is taken, but if you can grow it on your own, you probably don't even need funding. On the other hand, there is a worse thing that could happen. In the pursuit of owning the company or controlling the company that you have, that's the reason you're not taking funding, and hence end up not even growing the company. That's the worst thing to do. So like I said, every company needs to grow. That's the nature of business. And because of your trying to control the company, if you're not taking funding and not growing the company, that's probably the worst thing to do. So that I wanted to point out. So ultimate objective of everything is growth. And here I would also point out whether you might have heard this term called lifestyle business. There are businesses who are growing, who are profitable. They are making decent money for their founders, and the founders are happy with it. There are these kind of businesses, and sometimes they don't need funding. And these are what are called in our startup jargon the lifestyle businesses. The founders are running those businesses quite happily, making their money. There is absolutely nothing wrong with growing a good lifestyle business. It is just that this doesn't fit with the funding philosophy, because if the fund comes in, you are taking a partner in, and the partner has their own ideas of growth, and for their fund to return the money, they need growth very fast, and that may or may not be aligned with the idea of the lifestyle business owner. So as long as the business is growing to the scale that you want, you do not have to need funding. You can grow a very nice lifestyle business. But if you're wanting to scale up very fast, and for that external funding is required, then of course that becomes a startup, because that grows very fast, may need external funding. Lifestyle businesses may not. So I hope I have clarified that about who needs funding and what kind of businesses can run very successfully without any funding at all. That brings me to probably the most important slide of this presentation, which is what are the different stages of funding, and how do they map really to the life cycle of the product or the company or the product company. So what I'm showing here is that at various stages of the product life cycle, you need different kinds of funding. So let's say it starts with just an idea on paper, just a concept in the head of the founder. Obviously, it has to be more self-funded. The founder is working on it himself, is spending his or her own time without taking money from everybody. They're building the concept. And in the process of building this concept, then you sometimes need money to build that tech. And that is where people who believe in you, your friends and family might come in to help you with some funds to build that tech. And when I'm saying building tech here, let me clarify that tech is of course tech when it is technology companies, that you're actually trying to build that technology product. But like I said, I'm not just talking about technology companies. Now, for example, there is some agri startup and then you got to reach out to lots of farmers. Maybe there is just people that you're training to reach out to these people. So there is not much tech involved, but you're just building your offering, I would say, whether it's a tech or non-tech. You're building that offering. And for that, since you have nothing to show for it, it's either yourself who are funding it or your friends and family are funding this venture. So that is what this early stage is, which I'm calling the building of tech part of it. Then what happens is once you have the concept ready, you have some kind of going, then it comes to the stage of prototype building. And then that is where based on the, the kind of qualified idea, kind of firmed up idea, now angels will start coming in, angel funds will start coming in. So now they are looking at this idea and they say that, this idea could work. And why are they saying that? Because angels typically are experts in their own area of business activity. They have experience, they have the expertise, they know the problems that are happening in the market, which your friends and family may not, because they are just relying on you as the founder and they're investing in you. But the angels are probably experts in their field and they know that there is a problem, they know a solution is needed, and they have a fair idea that your solution might work or not. So it is there that, at that stage, that at the idea stage, that angel funds start coming. Of course, at this stage, some pre-seed funds also, venture funds also are getting in, and we are one of those funds where we are interested in companies that are pre-revenue also. If the idea is strong and the founders are very strong, we would like to build that, invest at that stage itself. And then of course you are taking the next, the fourth column that I'm showing there, where you're building on top of that. So what happens now is that your technology is built. You are getting the help of angel funds, and now you're building some kind of a product. But the technology can take various forms when it goes into the market. It is not necessary that the first form, and by form I mean the product form that the technology takes, it is not necessary that the first form that you have in mind will click in the market. You have to explore a little bit, and that's where this angel funding, this early stage funding comes into play, because now they're helping you explore various options and determine what is called the product market fit. So the same technology applied in different forms could either click or not click, and in this period you're using this funding to explore these options and figuring out what is the solution that works for the market the best. Now, towards the end of this phase, you're getting that product market fit. So now you're putting in more money behind the winner, the option that you thought of is going to click in the market. And that's where you need a slightly, still early stage funds, but maybe the seed stage, the pre-series A fund, because now you're getting closer to the product market fit. You got to push on to that particular option. That's where you're using the funds. So that's the second phase of getting the product market fit working. And you have various funds such as angel funds, angels themselves, or early stage pre-seed or pre-series A kind of funds coming in. I've mentioned crowdfunding there as well, and it is an option, but not so much in India. I must say that in India, crowdfunding for startups is not picked up that well. I think there is an issue about SEBI permissions and so on. So the angel list platform or the angel platforms have done quite well. The crowdsourcing has worked more for disaster relief and some health issues and raising money for that. Although in other countries, crowdsourcing has worked for startups as well. Beyond this stage is now where you've got the product market fit, and now the engine is in place, and all you have to do is pump in money to get the scale, to get the sales going. So that is what is called the growth stage, and that is where the Series A, Series B, and all those other alphabets of series funding starts happening. And our stage is we go up to Series A, and we want to take that early stage companies to Series A. But there are funds beyond that who are funding, going beyond Series A and Series B for the growth. Now it's just pumping in money to get the growth of it. So this is how the mapping of the product itself, or the product life cycle, or the company life cycle, happens with the funding stages and the kind of funds. I have put some numbers at the top, if you see, of what kind of amounts we are talking about here. And let me just say that this is a dynamic number. I have last year the numbers were different. Even 2 or 3 months back the numbers were different, and the numbers are different today. In the early stage, whatever numbers you're reading there are good for today in terms of, it's lakhs up to a crore for the early stage. And then in the second stage, it goes up to multiple crores. And then the growth funds are beyond 3 million and things like that. But these are today, depending on the market, these numbers could even increase. So that's about the amount. That's just take that as an indicator. It cannot be a very hard rule or anything like that. Even there's quite a bit of a difference of opinion when what you call a series A or pre-series A or something like that. So don't go by the terms, don't go by the numbers, but I hope I've given you the mapping. On the left, I've also shown a marker for profit. And that is an important point for startup, because a lot of these phases, the startups are not going to be making profits. They're building a product, they don't even have revenues. Even if they build a product and they're exploring, they're trying out various things, so they may not be making profits. So only in the later stage, when when you are going for the growth, you might, and even then the growth funds are really investing in your company to pump in the sales. They're putting in so much money that you may again not be profitable because there's so much money coming in and you've got to spend that to get the growth. So it's all growth at all costs, and hence it may still not be profitable. Only when it goes, the companies are ready to go IPO, they become profitable, and that's when they go to IPO, or at least that's what it used to be. Today, even non-profitable companies are going IPO, but that's a different topic that we can talk about separately. So this is, I believe I've given you an overview of all the stages of funding. So let me go to the next slide now, because that is most crucial to you, about how do you become funding worthy. All this discussion is fine, you get the lay of the land, but if you have to get funding, what is it that you have to look for? And I'll start with two extreme examples. One is an extreme where all green, in the sense investors are fighting so that they don't miss out the investment opportunity in you, in your company. That's the best case kind of a scenario. And I've heard this anecdotally, that this is what happened in the case of Google when they were raising funds. Two very large funds were fighting to get on the Google cap table. And ultimately what happened is that both those funds actually invested in Google at the same time. So that's the kind of situation where there is what is called as FOMO, fear of missing out. Investors fear that they will miss out on these big opportunities, and hence that is the best situation for the founder. Investors fighting to be investing in that. What is the worst case scenario? I have seen quite a few founders, entrepreneurs coming to me and saying that I have this idea, but it will work only if I get funding. If you give me the funding, then I'll make it work. And the corollary to this is, and I asked this question, so that means that if I give this funding to somebody else, even they can make it work. So that is not talking much about you as an entrepreneur. It's basically the funds, whoever gets the fund, they will make that venture successful. So that's the worst kind of scenario for the founders, because then, why would the investors invest in you? What the investors are looking for, as you can see from the chart below, is uniqueness. And the uniqueness that they seek in the founders can be different at different stages. So what can happen in the earlier stages, as I was mentioning earlier, friends and family, the uniqueness is their relationship with you. You are the one that they are dealing with, and that's why they are funding. Whereas you go to the angels, they are invested in the idea. So they find that idea unique, and that's why they are investing into you. Then later on, what happens is, you're starting getting the product market fit, you're starting getting traction. Then some of the seed stage funds or pre-series A, they are looking at the traction. That's why you're unique. So you not only have the idea, but now that traction is what makes you unique. Sometimes what happens is that there may be even larger companies than you in the market. But if you're growing faster, even that creates uniqueness for funds like us. So there may be competition. There will always be competition for good ideas. But if you are the one who are growing faster, so that's why the growth also can create uniqueness for startups. So that is what investors are really looking for. And because I understand that the audience is mostly early stage, initial stage founders, let me focus on what we are looking particularly in the early stage startups. In the early stage, like I said, the founders is the big deal. You're always looking at founders, because they are the key that why you're investing in that early stage. At early stage, what do you have to show? So do they have the talent? Do they have the commitment? And even what we look for, to be honest, is the mix that the founders bring to the table. Typically there are co-founders, and obviously somebody has to have tech knowledge. For example, for a tech startup, somebody has to be the hustler, the salesperson, and they are going out and bringing in the business. Very importantly, there has to be somebody who knows the domain, the problem that you're trying to solve, the industry vertical in which that problem is, and you're trying to solve that. So we are looking for this mix that is there. So if that is there, then the funds are looking to invest into those kind of startups. If you have to be very concise about this, what we are looking into in this aspect is why you. And that's why that's what I mentioned a little while earlier about those worst case scenarios. Why you is the question that we are trying to get an answer from the founders. Do they have the talent? Do they have the commitment? Do they have that complementary fit that fits that particular problem? So why you is the question that is being answered in that initial stage. The second aspect is the idea. Now, for when we are looking at, what is that idea? And what we really look for is that it answers the question, why now? So the first one was why you, the second one is why now? You may have a good idea, but ideas can be ahead of their time, behind their time. Why is it that today it is very important to work on this idea? And there could be, you could be riding a wave, there could be a timing, there could be a vision of the future that you can place. It is not just that my solution is, better somehow, or my solution is cheaper. There has to be some answer to this why now question. And that is what we are also looking at this initial stage. And how do we find answers to these questions? That's where the due diligence come in. We do a lot of due diligence on the founders themselves. We do a lot of due diligence on the idea, and we may not know all the verticals ourselves, obviously, but we can go out and talk to various experts in the field and get answers from them about the lay of the land, what the field looks like, what the space looks like. That's the due diligence piece that we as a fund do to get to know more about the founders and the answer to why you, and about the space and the answer to why now. Conversely, I would also advise the founders or the entrepreneurs to do a DD on the funds also. We have been subjected to that. Our investees have done their duty on us and found out where we would be of actual help to them. So money is there, of course. Today, there's a lot of liquidity, and they almost say that capital is commoditized. But you, at the early stage, you're not just looking at the money, you're also looking at the help that you can get, the alignment that you have with the investors in the firm and the funds. And are they filling gaps that you feel, you perceive in your organization, and could they help you with that? So I talked about our fund being for entrepreneurs, by entrepreneurs. We have been done global scaling. So sometimes those are the kind of things that people are looking for. Sometimes the knowledge of the SaaS matrix that we have is what people are looking for. So these funds, these companies, they are able to get money from various places, but they want to have a reason. The good companies want to have a reason for having each of the investors on their cap table. And we have examples of our investee companies seeking out our help for some of the specific problems that they're working on even after the investment. So I would definitely encourage founders also to do their own due diligence on the investors and make sure that they are fit and they're not just going after the money aspect of it, and make sure that if you're getting a partner, make sure you're comfortable with that partner and that partner really works in the interest of the company. So that was another important slide about what the initial stage entrepreneurs should look for and what investors are looking at them. Let me go to the next slide, which is, like I said in the beginning, I'm kind of answering the typical questions that get asked. And so the one question that always in the mind, founders work hard to build their company, but when they kind of get their first funding, there is a feeling of now there is success. If you've got funding, then it is success. And then there are lots of corollary points that come up that if funding is success, why not I go for as much funding as I can get? And I'm trying to answer this question in this particular slide. So why shouldn't I get as much funding as possible? Now, the thing, probably some of you are aware, some of you are not. It's all about the ownership of the company that you are running, and this ownership is a function of two things. One is how much your company valued, and how much are the funds that you are raising. So these are the two things, because when you're getting some funds in, you're getting an investor in proportion of the money that they're bringing in, and depending on the value of your company overall, you are giving some equity or some ownership of the company to these investors, the external investors. So let me dive a little bit into it about the valuation. What does the valuation depend on? It of course depends on the type of business, whether it is a product, whether it is a service, whether it is B2B or B2C. Every type of business has their own benchmarks of how the valuation will be done. And these are benchmarks that come from external data points. Where do these external data points come from? Some of them come from the acquisitions that have happened in the space. So if there is an acquisition, you know that some transaction happened, there was some value that is ascribed to that startup, and that's how you get data of valuation. In some other cases, the public markets might give you data because a larger company in the same space has gone IPO, and there are some data from the public markets. So these are the public benchmarks that determine the valuation. So that's one piece, as I said. Now, how much money do you raise? That is to be determined. That's what the point I'm making in the next bullet is, how much do you actually need? So funds like us will always ask how much is the money that you're needing, because we also want to know how will be the funds deployed. Where are you going to put the money so that that money takes you from point A to point B, and in how much time? That's what the fund is interested in knowing. So we will always analyze ultimately what are we doing as a fund. We have taken some money from our investors, and we want to return them up to their expectations. So we, when we are investing in anything, have to keep in mind that we are getting that kind of a return, and that hence we want to know that if you are taking money from us, where you're deploying it, where you'll take the company with that money, and in how much time. Now, this thesis can change from fund to fund. Naturally, every fund will have their different thesis. And that's where startups talk to multiple funds. They will negotiate and they will discover the valuation. And you will agree with me on this, that if there is a fund where the thesis aligns much better with you, they might give you more valuation. If the fund doesn't align, they will give you less valuation. So these negotiations is what leads to the valuation discovery, and hence finding the right investor is very important. Now, if you have realized the perspective of the investor looking at the funding and how important it is for them to grow, it must be realized that funding is only a step towards growth. It is not the end. It is not the success in itself. It is the first step towards the growth, which is going to make you successful as well as the investor successful. So a typical question that comes to me is that, like I said, the founders have worked hard to bring the company to a certain stage. Now, once the funding happens, should they be taking now market salary? Again, my question goes back to the growth. If the growth is being hurt by founders taking the market salary, I mean, nobody is saying that the founders should not be able to survive well. I mean, they should have enough. They should be making enough for them not to have to worry about their day-to-day and so on and so forth. They must be making that. But there is a gap between that threshold and market salary, as we all know. And when founders are incentivized by the stake in the company and the extremely high return that they're going to get, we do expect that the founders take that into account and show their skin in the game by taking not the market salary, but sufficient salary for them to go on, but focus on the growth of the company. So that, I hope, has clarified the issue of the role of funding in the success. It's not the end goal, but it's the first step. Then going on to the next FAQ, this we have seen a lot. Why do investors give crazy valuations to startups? We have seen that a lot, even when sometimes there are no profits in the company, and not even profits. Sometimes there are not even revenues. Forget about revenue. Sometimes the product is also not in place. So why are people investing so much? First of all, let me clarify this, that a lot of this is happening because, or a lot of this comes to us through the news, and news will always talk about the high valuations. There won't be any news about low valuations, for example. So there is a selection bias at play here, that we will only hear about the high valuations. But let us keep that aside. I know that the valuations have gone crazy even as compared to the last year. And what we have seen is essentially a liquidity that is happening. There's a lot of liquidity, there's a lot of money in the market, and hence that valuations have gone up. But let's keep that aside for the time being, and talk about why what justifies the valuation. So let's say we are looking at today's profits. Now, when the company is making profits and I'm investing in that company at that point, clearly the price of that company includes that profit that they're making. So that I'm already priced in. I mean, I'm giving that money or investing in that company, considering that they have that profit. What I'm interested in as an investor is how those profits are going to grow over the period of time, over the period of the next few years, so that I can get my return. So now looking at it the other way, if that initial profit is, let's say, not there, the profit is zero, or there are no revenues, or there is not even a product, now the valuation is go down because the profit is not priced in. So that means that you're getting that startup at a much lower valuation. And now if you are very confident about the story, about the founders, and that this idea is going to grow big, you can get that much more higher rewards of taking that investment at that lower valuation. So investors are always valuing based on the disruption from many years from now. And still, I mean, you would ask the question, but why would they not give a lower valuation than higher valuation? Of course, if we can, we will give lower valuation. But the fact is that the supply of these really good ideas is very low. There are really very few really good ideas out there. And you know what happens when the supply is low, the price rises. And that's what happens. There is a competition between funds to get into those kind of things and get those high rewards. I've even sometimes you'd be surprised to know that one entrepreneur has a track record. You've spent 10 years building something. They don't get valuation, but guy out of college gets higher valuation for the same kind of solution. And this entrepreneur is wondering why my track record is not helping me. The thing is this, that once you have a track record, the future growth, the future disruption is also based on what kind of track record you have. If that track record is middling, any investor will think that the future is also going to be middling. You're not going to say that suddenly you're going to be on a very high growth path. Whereas the person that doesn't have a track record, I am assuming a lot of people in the audience who are first-time entrepreneurs, you don't have a track record, then the potential is unrealized, and there could be some investor who would believe in you, your background, what you're saying, and they could imagine a much higher growth path. So it's always about growth, and hence somebody without a track record may get a better valuation than somebody with track record also. So everything is about this high reward, but obviously there is a high risk associated with it as well. And clearly you're investing in somebody who has no track record. There is a risk, and everybody understand that. We as a fund understand that startup is a riskiest asset class. Our investors understand that as well. So for the risk that they're taking, they are wanting those high kind of returns, and that's where this high growth is what is expected out of startups. We as a fund, manage this risk by taking a portfolio approach. So we don't expect that all the 20 startups we're investing in all will grow. Of course, the thesis is that they will all grow, but nobody knows the future, right? So there is a risk associated with it. So we assume, all funds assume that only a few of them will succeed, but they give that oversized return. Now, how do funds get their own returns as well? For a long time, now of course the situation has changed, but in the Indian ecosystem, the exits were not happening, and that was the big worry. But now, of course, there are lots of exits are happening at all stages. I'll just take you through that workflow. There is a new category that comes up, say e-commerce or something. Then a lot of people jump in, it becomes a crowded market. Then, of course, there is a consolidation. Some people lose out, some people win. The winners acquire some of the lesser successful ones. The consolidation happens. Then some of the winners get onto the profitability part, and then there is an exit with an IPO or something like that. Now, what happens is, in that ladder that I showed you earlier, if there is an exit like that, in the end, everybody has an incentive to give an exit to the previous investor. So the last investor, the larger fund, is going to get an exit to an IPO, but they are then ready to give an exit to an earlier seed stage investor because they know that they can get that later on growth. So that's how the seed stage will take them to, let's say, a series A. The new investor will come in and buy them out. So that's how they are getting an exit. Same thing happens backward. The seed investor will give an exit to the angel investors who have got them to the idea stage, and so on and so forth. So if there is an exit in the end, that at all stages you can expect to get the exit. I've given an example of very well-known example of Myntra and Flipkart, and now the exit to Walmart. Of course, again, as I said in the past, profitability is probably not considered that much. Even without profitability today, companies are going IPO, but that's, like I said, a different topic. So that's that takes me to the ecosystem that is available. I know that I think Dr. Dhruva is going to talk about exactly this topic in my next in the next session of Arthayan. So this is a very good segue to take into that. So I'll just give you a lay of the land here. And I talked about the grants that are given for the early stage when we're building the tech. And then there are the various foundations who have their focus on different areas, such as Will Grow is for agriculture and so on. Bill Gates Foundation, for example. So there are these foundations who are for that early tech. Then there are funds like us who are providing that seed stage, Series A or Series A, B, C kind of funds who are trying for either the pre-growth or the growth base of it. And you can see Pentathlon there. But I want to highlight this incubator part. It's this incubator part which is very important from the early stage, and there are of course the global ones by like Y Combinator, and there are like India Ideas to Impacts Hub like ourselves, who are really playing a key role in helping these younger stage entrepreneurs with not just mentoring but connects and help with funding access, help with go-to-market access, and so on. And really a new trend that I'm seeing, which is already there in the outside of India, but even in India, we're seeing that, is vertical-focused cohort-based programs. So you can see that if somebody is focused on retail, then a retail-based startup would be very comfortable and benefit the most by getting into that kind of an incubator. We ourselves are getting a Pune FinTech Hub started, Pune FinTech Forum started, and that is going to be focusing on the FinTech startups. Pune is a good startup location, and it's close enough to Mumbai, the financial capital, to do that. And that's what we're hoping to start. We are even thinking of starting a gaming hub, because the gaming is a lot of activity that is picking up, and we can help a lot of gaming content startups by putting together a partnership ecosystem of distributors and monetizing startups. So that is a new thing that is happening, and I wanted to highlight that. Otherwise, Dhruva will take you through the lay of the land for the investors. That brings me to the last slide, which is what are the takeaways. And of course, there are takeaways for the fundamental fundraising. I talked about if you need funding and when to take funding, from what kind of funds you approach, how most importantly the investors think, because I thought it was important that if you look at it from the investors' perspective, your pitch to them is going to be that much more better. And I hope in this deck I was able to help you put yourself in the investors' shoes. I talked about liquidity and a lot of funds being available, but don't for a minute think that it is easy to raise funds today, because there is a lot of competition. The competition is very high. We meet a lot of great founders, and that competition is what is bringing out the best of the entrepreneurs. So you got to really work hard, not only approach the right investors, but also work hard on your pitch, your story, to make sure that you are able to win over the competition. Hopefully I was able to show very clearly how funding works and how it is the beginning, and that is, I hope, the biggest takeaway for the startups, that how you look at funding. I also would like to talk about the opportunities. Today, the world is much, much better than even a few years back. Last year, the unicorns were 25. This year, I wrote in the slide of 50. Only today morning, I was looking at some website, they said it is 55. So the number of unicorns is already 55. So exponential growth is happening. The ecosystem is better than ever. There is more money, as I said. There is more maturity. There is great support available. Entrepreneurs are becoming VCs, for example. So founders have the very good ecosystem to work with. And I would also like to talk about the other part of the ecosystem. As I mentioned, there are other professionals who are attending this. And there is a lot of scope for technology experts or domain experts to become advisors and mentors in the startups, maybe against equity, and benefit out of the growth that they are able to provide them. Of course, this whole fund management industry is growing. So if you're a finance background, there is a career opportunities now as analysts, as principals, and eventually even as fund managers. HR advisors are always needed, recruitment and all of those problems. So there are lots of roles for professionals to play as well. But the bottom line is, it's still about the founders and the ideas and the difference that they can make. So I hope with that last line, I close my session.